I had this whole day planned. And then I saw someone post a side-by-side comparison. On one side, the DOJ settlement documents showing 8 major banks paid $1.3 billion in fines for rigging the silver market. On the other side, silver's performance in 2025, up 182%. And now here I am recording this right now, because if you don't connect those two dots, you're missing the entire story. For years, people said the silver market was manipulated. They were called conspiracy theorists. They were laughed at on financial television. They were told they didn't understand how markets work. And then the Department of Justice confirmed it. JPMorgan, Deutsche Bank, SBC, UBS, and 4 others. Systematic suppression through spoofing between 2008 and 2016. $1.3 billion in fines. Criminal convictions. Traders went to prison. And now, less than a decade after that suppression ended, silver just had one of the most explosive runs in modern commodity history. So the question isn't whether the market was rigged. The DOJ already answered that. The question is, what happens when you take the lid off a market that was held down for 8 years? I'm recording this right now from Phoenix, and I want you to comment what day and date you're watching from, because I want the timeline to be crystal clear, and this is one of those stories where the dates actually matter. And real quick, if you value this kind of no-drama, straight-shooting breakdown where we connect the pieces that mainstream media won't touch, do me a favor. Subscribe and comment FinTalk OG so the algorithm knows you want more of this. Now, in case you haven't seen what I'm talking about, here's the vibe that's been flying around. Silver was suppressed for years by major banks. They got caught. They paid fines. And now that the suppression is gone, silver is finally trading at something closer to its real value. 182% up. And on the surface, it sounds clean. Crime, punishment, price correction. But when you trace where a lot of these posts are coming from, and when you actually read the settlement documents, you realize the story is more complicated than the meme version. That's not the whole story. That's not even half of it. Because yes, the banks rigged the market. Yes, they paid fines. But the move we're seeing right now isn't just about releasing suppression. It's about what happened after the suppression ended. What changed structurally in the market, and whether the current price is fair value or just the beginning of an overcorrection in the other direction. So I'm going to break down 3 things. First, what actually happened during the spoofing years, what the banks did, how they got caught, and what the fines actually mean. Second, why silver didn't immediately explode after the settlements, why it took years, and what changed recently that caused the move. And third, what this means for you if you're holding silver, if you think it's going higher, or if you're wondering whether this run is justified or just hype-driven momentum that's going to reverse. So let's start with what we can verify. Between 2008 and 2016, traders at 8 major banks engaged in a practice called spoofing. Here's how it worked in plain English. A trader would place a large order to buy silver, which would signal to the market that there's demand, which would start pushing the price up. Then, before that order could be filled, the trader would cancel it and immediately place a sell order on the other side. The price would spike from the fake buy order, and then the trader would sell into that spike, profiting from the move they created artificially. Then they'd reverse it. They'd place a large sell order, tank the price, cancel the order, and buy at the lower price. This wasn't a one-time thing. This was systematic. Thousands of instances, algorithms designed specifically to manipulate order flow. And it wasn't just one bank, it was 8. Coordinated or not, the effect was the same. The price of silver was being pushed around by fake orders that were never intended to be executed. The DOJ and the CFTC, the Commodity Futures Trading Commission, they investigated. They found the evidence. JPMorgan paid over $900 million. Deutsche Bank, SBC, UBS, and others paid hundreds of millions more. Total settlements over $1.3 billion. Some traders were criminally charged. Some went to prison. The head of JPMorgan's precious metals desk convicted. This isn't alleged. This isn't a conspiracy theory. This is documented, settled, adjudicated fact. The silver market was rigged. Now here's where people get it wrong. They assume that as soon as the rigging stopped, silver should have exploded. It didn't. The last major settlement was around 2020. Silver was trading in the mid-20s at that time. It didn't immediately go to 50 or 70 or 100. It chopped. It went sideways. It had some moves, but nothing like what we're seeing right now as I'm recording this. So if the suppression ended years ago, why did it take until 2025 for silver to make this move? That's the question. And the answer is that removing suppression is not the same as creating demand. All the spoofing did was create artificial volatility and cap price discovery. Once that stopped, the market still had to find its natural level based on actual supply and demand. And for a few years, that natural level was in the 20s and low 30s because industrial demand was growing but not explosive. Investment demand was moderate, and there was no major macro catalyst pushing people into hard assets. What changed? Several things. First, industrial demand accelerated. Solar panel production ramped up globally because of policy and subsidies. EV production increased. Data center buildouts consumed more silver for electrical components. All of that demand is not discretionary. It's structural. It doesn't go away when sentiment shifts. Second, central banks around the world started buying precious metals again, not just gold, but also increasing their commodity exposure broadly as a hedge against currency risk. Third, and this is critical, the investment community started rotating into hard assets as a response to persistent inflation, fiscal expansion, and concerns about the stability of the financial system. That's a narrative shift. That's not spoofing ending. That's a structural change in how investors view risk. So yes, the suppression ending created the conditions for fair price discovery. But the move we're seeing right now is not just about releasing suppression. It's about real demand meeting constrained supply in an environment where investors are willing to pay up for physical assets. Those are two different things. The first place these stories usually get weak is when they treat the price move as purely a function of removing manipulation, as if the market was a coiled spring just waiting to be released. That's part of it. But it's not the whole story. Here's a question for you. If the banks hadn't rigged the market, do you think silver would have hit $100 back in 2011 during the last big run? Or do you think the fundamentals back then couldn't have supported that price anyway? Drop that in the comments because I read them and I want to know how you're thinking about this. Now let's talk about what fair value actually means, because this is where it gets uncomfortable. Fair value is not a number, it's a range. It's a function of supply, demand, sentiment, liquidity, and the alternatives available to investors. When silver was at $15 an ounce, was that fair value? If the market was being spoofed, no. That was suppressed value. When silver hit 120, is that fair value? Maybe. Depends on whether the demand that pushed it there is sustainable or whether it's momentum-driven buying that evaporates when sentiment shifts. The challenge with a market that was manipulated is that once the manipulation ends, you don't immediately know where the real price should be. You have to let the market find it. And markets don't find equilibrium smoothly. They overshoot. They undershoot. They oscillate until they settle. So when people say this is what fair market value looks like, what they're really saying is this is what the market trades at when you remove artificial suppression and add real demand. That's true. But it doesn't mean the current price is stable. It doesn't mean it won't correct. It doesn't mean it can't go higher. It just means that right now, at this moment, this is where buyers and sellers are meeting based on the information and sentiment available. If you're holding silver and you believe the suppression story and you believe the demand story, then the current price is justified in your framework. If you're skeptical, if you think this is a momentum trade that's going to exhaust, then the current price looks extended and due for a pullback. Both of those views can coexist. They're just operating on different time frames and different assumptions. Now here's the skeptical alternative. Could silver pull back significantly from here? Yes. Could we see a scenario where it drops back to 90, 80, 70, and the narrative shifts from fair value to speculative bubble? Absolutely. Here's how it can fail. If industrial demand slows because of a global recession, silver loses one of its core bid sources. If investment demand reverses because risk appetite comes back into equities, silver gets sold. If a major holder, a fund, an ETF, a sovereign entity, if they decide to liquidate a large position, that can create a cascade. And if sentiment shifts from silver as a must-own asset to silver as a crowded trade, the exit can be fast and painful. That's plausible. That's not fear-mongering. That's acknowledging that the same volatility that took silver up 182% can take it down 40 or 50% without invalidating the long-term thesis. And I'm going to say something that might annoy both sides. The banks rigging the market was real. The move we're seeing right now is also real. Those two things can both be true, and it still doesn't tell you where silver is going next. A correlation is not a contract. Just because suppression ended doesn't mean the price only goes up. Just because the price went up 182% doesn't mean it was all because of releasing suppression. The market is more complex than that. And if you're treating this like a simple cause and effect, you're going to get surprised when the market does something that doesn't fit your narrative. Now let's map two plausible paths without pretending we can predict the exact candle. Path 1. Silver consolidates at current levels, call it the low 120s for a while. Momentum cools. Retail takes profits. The headlines quiet down. And then, over the next year, industrial demand continues to build, investment demand stays steady, and silver grinds higher. Not explosive, not parabolic, just a steady bid that takes it to 130, 140, 150 over time. That's within the set of things this market is capable of doing. Path 2. Silver doesn't consolidate. It corrects. Hard. Drops to 100, 90, maybe 80. Everyone who bought at 120 panics. The narrative shifts from fair value to bubble. And then, after the correction, after the weak hands are shaken out, the structural demand reasserts itself and silver bottoms, stabilizes, and eventually makes new highs. That's also plausible. Both of these worlds can be true in different timelines. I'm not predicting one over the other. I'm saying both fit the structure of a market that was suppressed, released, and is now finding its level in real time. Here's what to watch. First, watch for any new regulatory scrutiny or enforcement actions. If there's any indication that spoofing or manipulation is happening again, that changes everything. If the market is clean, the price action is more trustworthy. Second, watch industrial demand data. If solar, EV, and data center buildouts continue at pace, the demand story holds. If those sectors slow, the demand story weakens. Third, watch investment flows. If silver ETFs continue to see inflows, that's confirmation that institutional money believes in the move. If those flows reverse, that's a warning. And fourth, watch the narratives. If the conversation shifts from fundamentals to speculation, from smart money to retail FOMO, that's usually a sign that the move is getting tired. Now here's the uncomfortable part. If you believe the suppression story and you believe that silver was held down artificially for years, then logically you have to accept that the current price might still be below where it should be. But you also have to accept that markets don't care about should. They care about supply and demand in the moment. And in the moment, sentiment can overwhelm fundamentals. So even if you're right about the long-term fair value being higher, you can still get crushed in the short term if you're sized wrong or if you're using leverage. And this is why the story matters less than the plan. The story gets you interested. The plan keeps you solvent. So what do you actually do with this information? Here's a simple action plan. No drama. Step 1. Decide your maximum allocation first. Write it down. If silver drops 40% from here, are you buying more, holding, or selling? If you don't know the answer before it happens, you'll make the wrong decision in the moment. Step 2. If you're already in and you're up big, take some off. Not all. Some. If your position doubled or tripled, trim it. Lock in gains. Let the rest run. That way, if it corrects, you're not devastated. If it rips higher, you're still playing. Step 3. Don't use leverage. Silver's volatility is leverage enough. If you're in futures, if you're in options, understand that you can be right about the direction and still lose money if the timing is off. Step 4. The best time to buy isn't when you're reading about how the banks rigged it and now it's finally free. The best time to buy is when you can think clearly, when you're not emotionally attached to the narrative, and when you've done the math on what happens if you're wrong. Now, here are my questions for you. Do you think the 182% move is fair value, or do you think this is an overcorrection that's going to pull back? And if you had to guess, do you think the banks are still involved in this market, just in ways we can't see yet? Drop your answer below and remember to include what day and date you're watching from. If you got value out of this, subscribe and comment FinTalk OG so I know you want a follow-up when we get more data on how this plays out. And if this helped you, share it with someone who's been following the suppression story and trying to figure out what it actually means for the price. All right, keep your head clear, and I'll talk to you soon. And just so we're crystal clear, this is educational content. It's my take based on publicly discussed information and my own reasoning, and it's not personal financial advice. I'm not your advisor. I don't know your goals or your risk tolerance, and I could be wrong. Do your own homework. Consider your situation. And if you need personal advice, get it from a qualified professional who knows your situation.